Hi, this is Herb Strather, your coach, and today we're going to get into what we mean by a BYOB. Now you'll find that on page 36. It's the balance sheet form that we've previously talked about. You'll find it right there as part of that whole exercise. Now, what do I mean by a BYOB and what is the purpose of it? BYOB initials stand for Be Your Own Bank. Be Your Own Bank. And what we are attempting to do here is to create some money for you in a bank account that is temporarily collateralized, but that maybe you can use it in the future by substituting collateral or even getting it released because of your credit score increase. So how does this go? How does this work? It starts with this. You would go to a lender and you would, and when I say lender, a affordable lender, and most of the ones that I know are credit unions. Most credit unions, they have what you call shareholder accounts. Now remember, on a credit union, you are a member and not a customer. At the bank, you are a customer, they make money off you. Credit union, as a member, they theoretically would make some money, but you being a member, that's some of your money because you co-own the credit union with everybody else as a member. It's member driven and not shareholder driven. So your status at a credit union is different. Credit unions are not subject to all of the rules and regulations that the bank have. For an example, Dodd-Frank is applicable to some aspects of the credit union, but not all aspects. One of the big differences come in when you try to borrow your own money back. If you go to a lender, a regular bank, and say you have 10 grand into the account and you want to borrow the 10 grand out, you might end up with an interest rate of 5 or 6%. Now you got to admit, that's pretty a hefty amount, 5 or 6% to borrow your own money back. Whereas you go to a credit union, you would get anywhere from 2.5% to 4%. A vast difference. I once inquired with the lender about why it was so much, and the thing that I got was more or less the banks had to still put up reserves. What are you going to do with the money? And they had to put some reserves up. And reserves are basically monies that you put up against losses. If in the event that there are losses, you put reserves up to cover it. You know, it's kind of hard to see where you're going to have a loss on a 100% secured savings account. But go figure, they still put reserves up. And the lenders that I've went to, all except in Detroit, it's First Independence National Bank. Detroit Independence National Bank have a program that will loan you the money to start your own savings account. In other words, they will do the same thing that we do. We loan you the money to start your savings account or your shareholders account, and you pledge that as collateral, and you borrow it back and you give us our money back. Now, it's a small amount to do it. It's 1% cost to do it that we have for the paperwork and all of that kind of stuff. And only our students can do it. If you're not a student, you cannot do a BYOB with us. We only do it with our students because there's a game plan. We're not doing this for a zero-sum game. In other words, if I loan you 20 grand, you put the 20 grand into a savings account, you pledge that savings account and borrow that money back out, give me my money back. What do you have? You have a $20,000 loan and a $20,000 liability. You can't go buy a car with the $20,000. So you say, Herb, what's the purpose of it? Well, here's the purpose. Number one, it strengthens your credit score. It strengthens your credit score as long as the loan is not too much. If the loan is too big, and 20 grand might be too big in some cases, especially if you have a modest income, it will knock your ratio off too much. In other words, your debt to income ratio could be impacted if all of a sudden you got a $400 payment that you had to make to the bank. Now, the good news is that you really don't make the payment because how we set it up, they simply debit your savings account and take the money out. What you would be responsible for is the interest itself. So take interest on $10,000. $10,000 at 2.5% is $250 a month. That's $20, $21 a month. You can afford that without too much of a problem. Now, if Now, but the payment itself would be closer to $200. That would be reflected on your credit report. $200. Okay. Now let's take it to $25,000. Well, a $25,000 payment will show up at $500. $500 a month payment is going to impact a lot of people's income to debt ratio, because the computer will assume that you're making that actual payment and it's coming out of your income, which will push your credit score down. So it's very, very important that we measure this correctly. What we would like for you to do when you fill out your balance sheet and when you fill out your goals, you're online, you call us and let's go over it. You have a right to call us and sit down and go over your balance sheet and your goal sheet and have everything intact, and let us create the way forward. How are we going to do this? How much money are we going to take from the BYOB, for example? If any, you may have enough money that you don't need to do a BYOB. So let's go over the benefits of the BYOB. First, we're talking about enhancing your credit score. Number two, it's a forced savings account. Now that means if you actually pay the payment itself and not have it deducted, it forces you to save. It forces you to save. And many of you, it's difficult to save. This forces you. Now, just so happened, the way the First Independence National Bank hook up the BYOB, it is a forced account because the money they loan you will be in a form of a certificate of deposit, a CD, not a savings account, which means that when you make the payment, you have to make the payment on your own. It's not deducted from the savings account. You will have to make it on your own. Excuse me. Good coffee. First Independence National Bank loans you the money to buy a certificate of deposit. You pledge that certificate of deposit and borrow against it, okay? And so essentially they loan you the money to open up to buy a certificate and to get the loan, and they're repaid back all simultaneously. We, Strather Academy, loan you the money to put in a savings account, not a certificate of deposit. The savings account can be used to debit to make the payment, thereby forcing you to be on time. You couldn't default if you wanted because it's an automatic deduction. The only way the default would happen is if you don't have enough money in that savings account to make the payment. Now you're going to usually have the money. It's a question of the only thing that eats it up is interest, so just keep enough interest. We require you to put 1 year's interest up. 1 year's interest up and pay 1%. So let's go over the benefits again. It impacts your credit score. The ideal is to increase your credit score. It's a forced savings account. It builds the relationship with the lender. It's a relationship builder. You develop a relationship with your lender. It incidentally also gives you interest on your income tax return, and that's important because if you have a balance sheet and you put that you have $25,000, they're going to want to know, well, where's the interest at? So it does give you interest, not a lot, because interest, the savings rate is so small now. It's under 1%. So even if you had $100,000 in it, it wouldn't even be $1,000. So it is a small amount, but nonetheless, it is interest. And finally, it gives you a shot at substituting collateral. Say that, substituting collateral. Now, what do you mean by that? If you have been successful, say you started off with a 660 credit score, it increases about 10 points a month is what we've been observing. And say now your credit score is 700. 700 credit score. You found a beautiful house that you like. The house is worth $50,000. You can buy it for 10. So you may go to them and say, look, you have $10,000 in savings here. I have a $50,000 house, appraisal is free and clear, beautiful home. Will you substitute the collateral? Will you take this house as collateral and release the $10,000? Now that's a way of kind of backing into a mortgage. I think the more clever way is to, if you didn't need all of the cash, you want to put some real estate up and some cash. For example, say you have a $20,000 BYOB at the bank. you found a house and the house took 12 grand. So you want to take 12 grand out and give them a mortgage. So they now have 8,000 in cash plus a mortgage for the $20,000 loan that you have outstanding. It's possible that your lender is going to say, well, we need to run this through the mortgage department. Well, but we believe it's much easier to substitute collateral than it is to go out and fresh and get a mortgage from day one. But don't forget, if they did substitute, they are still going to want a title insurance policy. You got to have good title to it and all of that. They're going to want what you would normally have on a real estate transaction. So the chances of that deal flipping over to the real estate department is good. But you can finagle that. You're in a better position because you have your own money you're using. You're saying, this is my money. Can I use this money to buy the real estate instead? So that's the purpose of the BYOB. It strengthens your balance sheet also. Now try a little interesting thing. You might say, look, I want to do this balance sheet. What you do not want necessarily is to have the loan on for the BYOB just standing out right on your credit score. In other words, you got a $12,000 cash in the bank and there's a $12,000 liability, which is true, you do have that. But if there was a way to create the $12,000 so it wouldn't be so apparent, for example, if you have a piece of real estate, you can tell them, look, I want to give you a mortgage on the real estate and I want to give you the assignment of the shareholder account. In other words, you have double collateral. So really, it can easily show up as a mortgage. As long as there's a mortgage on the real estate too, it may be doubly insured, doubly collateralized. In other words, you have your BYOB full account collateralizing it, plus you offered a loan on the mortgage, you offered a mortgage on your real estate. Now I like that. Because if you did that and they accepted that as double collateral, then somewhere along the line, what you like to do is just release the cash part. They have the real estate. I hope you enjoyed this exercise. Some of you are going to do it more creatively than I've explained, and I would love to have some feedback on how you did it and how successful you are. So just remember, the BYOB is available for every single student that takes our online course. It is important that we set you up to get your credit score and your balance sheet and give you the ability to finance as we teach you how to find the real estate. Because once you find it, and we want your credit score to be there and we want you to have some cash. It's really good talking to you. This is Herb Strather, your coach, signing off on BYOB. See you next week.